Hello, everyone. It's a pleasure here to be with Bala. Bala is the CEO and Managing Director at Aditya Birla Sun Life Asset Management Company. And actually, Bala needs no introduction because Bala has been a veteran in the industry last 26 years in different roles, all the way from being the chief investment officer of various funds to different positions during his tenure, and currently leads the entire business. And you manage about close to about $40 billion, give or take, between India and Southeast Asia, right, Bala?
Yes. Yeah,
Okay,
roughly about $36 billion assets under management. Of course, it's all built over a period of 25 years.
great.
Yeah.
So it's an honor to be with you, sir. And I am part of Paytm Money. I run the business and growth teams at Paytm Money. And given a lot of first-time investors and new investors are on our platform. We are on a mission to democratize investments in mutual funds in India. So it's been a great journey so far, and just given the market volatility in the last couple of weeks, we know that's happening globally. Wanted to get your perspective and ask you a few questions which would benefit both Paytm Money users at large as well as the larger investor base in India. So with that, I'd like to sort of anchor this conversation. It's we are in definitely a better shape than we were in the last couple of weeks. I think the worst was March 23rd, globally as well as in India, and then markets have recovered since then. Actually, it's up 800 points today. So Bala, what is going on? And it's for in most people's mind, it is they're trying to anchor themselves. Is the market going to come back? Why did it crash so fast? So what if you can just level set there, and what are some of the forces driving the markets right now?
Yeah. Yeah. Thanks, Gaurav, to have me part of your the conversation and part of Paytm. And I'm quite honored to be part of the discussion. I think the market, if you look at while the market fell, as you rightly put it, they fell from the peak of 42,000 index Sensex. It fell to as low about 26,000. And of course, the sell-off came big time, more as a part of the process of resetting the economy on the low growth, resetting the numbers of companies, earnings of companies, and that's something which I think got reset. And there was a panic selling that came from overseas investors, because this pandemic is not related only India; it's actually related to the global market. As
Right.
they saw sell-off coming in global market, they started selling in India too. But I think last few days, as you rightly put it, I think markets have gone up, no doubt. And from the bottom, it has recovered. Again, it's a purely a function of a short covering. I think in any market falls, you have a genuine selling that people actually who short the market and they press the fall further down. And I think if I look at as the market started improving last 3 4 days,
Mhm.
I think it came on the back of some bit of buying has been coming from overseas. Yesterday was positive, and today again some bit of buying seems to be happening. And second is short covering also comes, and that again reflects on the futures and spot market. First, future market trades at discount means that people are still shorting, still negative. I think the combination of these things. I think I think the market is recovering. At the end of the day, the news flows, if you look at when the market fell, the news flows were coming continuously negative. Whether it is lockdown on only on India, lockdown on the global market, and the number of cases were rising, both in the case of detected cases and as well as the people who are dying, the both numbers are rising. So nobody was sure about how things are going to shape up. That is a complete fear factor. I think if you take the 43% fall, the
Mhm.
26,000 index came, some of it came purely on account of the last leg came on account of, I would say, a fear factor, and which I think got reversed to some extent.
Okay, great. And what would you? So there have been people who are invested in the market and who have been invested in the market for a long time, and they might have some history of having seen such falls in the past, and they would be a little bit matured because they have experience, having seen falls. But there are also a lot of first-time investors, including are type of investors who might have just put money in 2019 or 2018, potentially at higher valuations, comparatively higher valuations, and they would see major drawdowns. What is the message that you give to an average investor, to calm his nerves and not really sell at the most inopportune moment? So how do you do that in general, not just for us but overall in the market? What
Yeah.
would you say?
Yeah, I think I think the point is right. I think the people who have come into the equity mutual fund schemes or equity direct funds, either side you take it, and the last 1 year and 2 year and 3 year, I have not been making money. And maybe even if somebody makes money, it will be marginal money they'll be making. And that's something which again function of market fluctuation, the way I think the market fell. The naturally has taken away the profit. Somebody interestingly told me that 1 month back the index was up by 30%. 30%. 1 month back the index is up by 30%.
Right.
And from there I think index is down by about 30%. So I think the way you look at is something is different. Having seen this, I think historically, I'll just draw a parallel to what I had myself seen. I think the Arshimeta scam time, which is 1992, market fell very sharply. 1999, technology bubbles happened. It fell sharply. Immediately after that, we have a local scam. Again, market fell sharply in the 2001. Then 2008, we saw Lehman Brothers crisis. As the institution collapsed, the market went for a toss for about 1.5 2 years. Again, bounced back. The equity market, whenever it goes through this kind of time period, we will see these fluctuations. We will see our own investment value getting eroded. But I think one should not worry about it for the one simple reason that the market, which has fallen as sharp as 43%, normally retraces back by about 20-20% as a matter of coming to a mean point. And then as the government start taking steps to improve the economic activities, right? The economic activities come back. The government of India will take some kind of steps to revive the economic growth and confidence. Mm-hmm. Reserve Bank of India already been doing it. That's what normally happens every time. Then the sentiment backs. Then when the market starts moving up, you will also see equally a big rise that comes in. Therefore, from investors' point of view, common questions which I used to hear in the past is that what should I redeem or what should I do? I would assume I would rather suggest that investors should stay put on these kind of occasions. Sometimes no action is better action. At the same time, such a sharp fall should also be considered as an opportunity to revisit the portfolio and make maybe an add-on investment into the existing schemes in which we have an asset exposure, or increase exposure in this period of time in order to get the averaging right. So that is why I think the fall should also be used as an opportunity, as long as the time period for the investor has come. He has come for a long term. And I mean long term has to be for 5-10 years kind of period, for which with that mindset when he comes, I think the people who come in your platform, naturally they would come in not for just for the purpose of trading or just taking exposure. He comes with some kind of purpose, with the goal in mind, and make the investment. Therefore, he has to stay invested, and of course, he has to stay calm and patient as well.
Right. So just to reiterate and rephrase what you just mentioned, you would suggest that people who have existing SIPs continue to do that SIPs, also take advantage of lump sum when there are sharp falls, to keep investing in their funds which they have held for a long time, or maybe get into funds where they didn't have the opportunity earlier, like certain sectors like small cap, etc., who might be actually be more valuation wise more attractive now than compared to times. So just a related question on that, not so much from investor, but from a market perspective, you see this trend of the US markets go up on one day. So you said basically going into now India markets like 245 today, India markets done well. Sort of it's the cycle goes into Southeast Asia, and then the future start reflecting next, and most likely see the US market go up, and then it works in tandem. But do you see like the Indian situation, just in terms of how this COVID-19 situation plays out, it may or maybe a little bit even better or worse than what it will be in globally, both in Europe and US? Do you see a dislocation of any kinds, or do you see whatever is happening there, we just completely blindly, our markets are completely blindly following that trend?
Yeah.
Where if the US markets go up, we go up. If they go down, we go down without. Do you see a strong correlation?
Yeah, there is a strong correlation because the money that come from overseas, it goes in all markets, and the market sentiment driven by the sentiment that prevails in overseas market.
Right.
While that is not the case most of the time, I think these are, especially in uncertain time, people do look at each other markets, and then accordingly the market starts behaving. I think where this will reverse, I think ultimately somewhere it also reverse where the India probably would stand apart compared to the global markets when our economy starts performing better than the global economy. I think there will be some disconnect which will come where Indian economy being completely different from the US economy or European economy or Japan economy. I think there's a lot of self-driven the spending that the Indian government can do, more inward focused activities that it can take. Once that starts playing out, then we'll see the disconnection happening. And that is the time I think more convictions will come on India as a emerging market story, not as a global market story. So therefore, that delinkages is not going to come immediately. It will take some time. But historically, we have seen the Indian market get disconnected once we start doing certain things which are more meant for India in all parameters, whether it is on interest rate, whether it is on GDP growth, whether it is on the benefiting out of oil price that has fallen globally. We want to start getting benefit of that. Then rural income going up because agriculture output being better, and so on and so forth. Once this starts playing out, then the disconnect will happen. Until such time, we'll see. And on the contrary, I'll tell you, I was just interestingly, I was seeing a number. The Dow Jones, Nasdaq, and a few other countries indices have gone up by. I'm just taking a 15-day number. I'm not even taking a longer term number.
Right.
15 days or 30 days number, 30 days of negative, 15 days actually is positive everywhere. Whereas India is still 15 days number is marginally positive, not big positive. When it fell, we fell very sharply. There is no doubt. When it was rising, we are not gone up as much as the rise that we have seen in Dow Jones and Nasdaq in the recent last 2-3 weeks.
Right.
So that's again the function of money flow.
Right.
Yeah.
Interesting. So Bala, what would you what would you say to the investor in terms, because at these times, asset allocation becomes very important. Somebody whose risk profile is, say, on the less risky side, and there is a need for funds in the near future, they might have been heavily weighted in equities, as an example. On the contrary, somebody who's middle-aged, has a decent job, has many years to go in their employment years, would rather shift into equities. But people always don't do that. So how would you, in layman terms explain the asset allocation concept to people, and using asset allocation as a tool to mirror their risk profile, and also be able for them to understand, where they actually stand. People sometimes overestimate or underestimate their true psychology, but when actually markets fall or there are sharp changes in the market, they behave very differently than what they thought they would, right? So how would you anchor that conversation? What would you recommend?
Yeah, I think interestingly, actually, I think global model is built with asset allocation model. Asset allocation is nothing but the risk profile of every investor. The risk profile is driven on the basis of what is his current earnings, what is his future potential earnings, what is his net worth, and what the kind of risk he is willing to take, given the fact that his future earnings abilities remains low or high. I think that also will, I think, set his risk appetite. So taking all this into account, you can divide this in the customers list into 3 parts: conservative set of customers, and moderate risk-taking customers, and aggressive risk-taking customers. Purely on the basis of what I mentioned earlier in terms of his net worth and other earnings potentials. The conservative investors, probably I would say, I think whenever we make investments into mutual funds, I always suggest the first attempt should be to make 50-50, 100 rupees I have, 50 rupees I put in equity, 50 rupees in a debt, and then they will start with that. And depending upon which segment in which you follow, conservative, moderate, aggressive investors, the 50 can go up to, of course, 65 if I'm an aggressive investors, and if I'm a conservative investors, 50 can come down to say 35 or 40, and in equity investing, and then the balance can be into the mutual fund fixed income schemes, which are again yeah, reasonably stable, less volatile fixed income schemes. Itself will give a better experience to investors. I think if I apply this principle, and then once we revisit this strategy every now and then, you can move assets from one to other by marginally by through the asset allocation course correction model. So that's the way I think normally is done. The reason why I'm specifically saying this is I think it's very important for investors, especially as you posed a question earlier, that 1 year, 3 year, 5 year returns on equity have not been that satisfactory. Whereas if we take 7 years, very good. If we take 10 years, very good. So one will go through this kind of ups and downs in every market cycle, where suddenly you'll realize one asset class has not delivered to your expectations. It can happen in real estate, it can happen in gold, it can happen in equity, it can happen in debt as well. So this is where the asset allocation plays an important role. When something does badly, you have something is doing well. When something is doing badly, something is doing well. I think this kind of ups and downs, the longer it takes. Let's say in the US, very established asset allocation model they all follow. The setup players like us, money managers like us, we will of course play in the market or invest in the market depending upon what the outlook is. But from a common investor's point of view, they also start doing our job in terms of occupying their mind, worrying about many things, forgetting the asset allocation model that we should adapt. Then they'll also carry the fluctuation in terms of their own mindset. So that is where I think asset allocation can play a very important, big role in the mind of investors.
Yeah, absolutely. And then what would you say to there are people who invested in liquid funds recently and they haven't, and debt funds, so returns have been negative or unsatisfactory. Should they stick around? What should be the outlook there?
Yeah, I think naturally in the fixed income space also you go through the same cycle. Fixed income, of course, we the liquid fund, I think month of March there were some negative returns. There is again a temporary. That was largely due to the March end year-end pressure that came, which normally comes every year. The yields move up, interest rates move up,
right?
Liquidity become tight. Reserve Bank of India took a step on 28th of March to calm down the market. They brought down the interest rates. They provide more liquidity in the system. Therefore, interest rates have come down. Therefore, liquid fund now is back to normal. So the 1 week, yes, there was a negative return. There is absolutely no doubt because of the mark-to-market fluctuation. Because mutual fund, please remember that we are every day, depending upon the market fluctuation, we'll mark up the portfolio or mark down the portfolio on a daily basis. That's where NAV comes. Therefore, you may see the negative return is coming. But in fixed income, if we give a time frame, I always believe that in fixed income, the accrual of interest, which comes every day in the fixed income portfolio, plus the price fluctuation, the accrual of interest component in the portfolio on a daily basis is quite larger than the market fluctuation. Therefore, if I give a time, the accrual component takes care of the portfolio return. Therefore, in fixed income, my always advice has been not to get worried unless until money managers like us make mistakes of buying into some credit, which suddenly goes burst.
Yeah. So there are no significant defaults, then they should be fine.
Exactly.
Okay. And then given what's happened, there's also been an extension to invest in tax saving vehicles for the past financial year. Should investors still consider ELSS and tax saving funds as a good opportunity, not just to build their wealth but also to save taxes in this time frame? What do you think?
I think interestingly, Gaurav, I think ELSS schemes can be considered for both. I think people can use it for creating wealth as well as for tax purpose under Section 80C.
Right.
And this time around, Government of India, because of the March was relatively a washout month, a lot of lockdowns happened on 31st of March. Most of the people make an application for getting a tax benefit before 31st of March. This time, many could not do it because of lockdown. So Government of India was kind enough to extend this deadline to make this investment before 30th June. So as long as you are able to show the receipt and at the time of filing a return, if you are able to show this, I think it should be okay. Even if your account gets debited today in the account, that's something to think one should look at it. Second is when I mentioned about the wealth purpose, also you can make investment. The beauty of real asset scheme, there is a lock-in of 3 years. And generally, when the moment the investors get locked himself or herself in a real asset scheme for 3 years, the tendency to stay invested beyond 3 years is very, very high. Therefore, the wealth creation becomes reasonably certain in the long period of time. So that's the advantage of real asset schemes. Therefore, if somebody has got an appetite, I think one should not consider only for the purpose of taxation. They should also consider for the purpose of investing in equity from the longer term perspective.
Okay, awesome. No, that's a good point. And then if you look at, and people start to compare returns, so look at like the mutual funds which have been holding gold as an asset class, you would see the returns anywhere from 35 to 40% year to date. So again, coming back to the concept of asset allocation, if somebody had like at least 10% to alternative assets and commodities, which includes gold, it's maybe you could back test it, but would you say that they would have been in a better shape, just overall portfolio allocation perspective, if they had like 10, 15, 20% depending on the size of their portfolio in gold as an example, or should they still consider gold given all the volatility?
Yeah, so I think gold, as you rightly put it, Gaurav, is I think gold can be part of the overall asset allocations. I think when I look at the every savings of the customer goes into the first savings account, fixed deposit, and then goes into the interest-bearing instruments like FDs, then goes into postal deposits and so on and so forth. It comes in equity. Therefore, gold should also be considered as part of those consideration, asset consideration for the purpose of making investment. But I think if I choose mutual fund, I think mutual fund offers a gold ETF. I think if you have to choose within the mutual fund schemes, you have fixed income schemes ranging from liquid fund to debt funds. It takes care of your fixed deposit needs. Mm-hmm. Then I mean, equity takes care of the wealth needs. Tax saving scheme takes care of the tax purpose related investment that one has to make. That takes care of that. I think gold can play a role in the overall asset allocation. But having said that, if somebody, I think gold, if you look at last say 15, 20 years average return, would be roughly about 4-5% return that would have given. If you have to draw a parallel of the same thing on fixed income schemes, would have given you ranging from 7 to 9%. Right. Therefore, one has to look at from that angle. Just because we have to diversify, do I need to just put in gold just for the sake of having satisfaction? I have diversified my portfolio, or should I make the same investment which would otherwise have gone to gold? Even if I keep it in say liquid fund, it would give about say 5 to 7% return, and gold also is going to give more or less the same return, if at all, if not the best. Right. So I think if you keep this principle, I think one can meet the needs of such investment opportunity in these two asset class itself.
Right. Okay. And so just a related question, Bala. So now given the change in markets, typically when you see equities giving a return at a standard clip, or sometimes 8%, some 10%, sometimes 15-20%, depending on the market that you're invested in. What should an investor think? How should he anchor himself in terms of the person who's actually entering into the market now? Because in fact, if you probably were to enter the market now because of at least relatively lower valuations, you might see your return expectations to be higher. But let's say look at the markets in January or last year, for people who actually put fresh money at that particular point in time, their return expectation would actually eventually be lower. So what would you say to existing investors? Again, I'm coming back to the same question. And what would you say to investors who are now trying to get into the market, either because it were totally in cash, or they just happen to be first-time investors? What should they, for the next 3 to 5 years, what is the outlook that you see, at least for the Indian market?
Yeah. So I think outlook for next 3 to 5 years can potentially turn out to be more bright. The reason could be one, the oil price globally is down. I think it's going to stay low for a long period of time. Right. Interest rates have been cut substantially. Inflation fear is not there. And that's going to again benefit India, so to speak. And third is, this time the government, while the last 4 or 5 years, government has been focusing more on social sectors and less of economic activities. Though they have done many things, but still the government is doing a lot of things which are more long-term in nature. with this COVID-related experience, I would assume the government of India may rally around the Indian entrepreneurs and corporates to bring in the next round of policy to revive the economic growth. So keeping this in mind, I think one should come to fresh investors, should make investments in equity, clearly keeping in mind that I'm coming with the assumptions and I'm going to stay with the funds for 5-year and 10-year period, and then he starts building his portfolio. Existing investors, the moment you think about selling it, then you realize your loss. So I think one should remember that, and then you are crystallizing. Once the loss is crystallized, and my value is never recovered back. So keeping this in mind, I would assume that existing investors, if they have some kind of more appetite, they should probably look at investing more at the right time on a falling market and build up their portfolio. And if they can't put more money, at least give this due time for the portfolio to come back to a positive return first, normal, and then positive return.
Awesome. Thank you.
Yeah.
Thank you. Yeah, I think you covered most of it and all the pertinent points. Is there anything else you'd like to say or mention?
Yeah. No, thanks, Gaurav. I think the key for investing remains is the asset allocation, and the key to remain in the market is to stay invested for longer term. What the question normally being asked, how do I time the market? So we always say that timing the market is not very important. Time in the market is important.
Yeah,
and these are the basic principles. If assuming one is able to keep it, I think one can build a reasonably good portfolio to the mutual fund over a period of time.
Great. Thank you, Bala, and thank you for all the insights. That will be very valuable to the investors at large. Thank you again.
Yeah, thank you, Gaurav. Thanks.